Welcome. Thank you so much for joining us. I don't know about you guys, but it's been a very busy start to the year. And the universe has gifted us a lot to talk about. So we're going to cover a lot of things. We'll take a quick look back at what the market did in 2024, because I think it helps sets the stage for what we're expecting next year. We'll talk a little bit about where we are in the business cycle with an economic overview. And then we'll talk about what's happening in markets, areas that we're looking at, opportunities that we see, risks that we see. I also have a couple of slides towards the back talking about policy and like areas of policy that we're looking at with the new presidential administration. We are day 3 into this journey, and it is still a very fluid environment. So the slides themselves are fairly light, but I'm happy to answer questions on what we're looking for there or on anything else that we talk about. So as we go through this discussion, know that you can click on the Q&A button at the bottom of your screen, and you can just type in anything there. We'll save plenty of time at the end for any questions that you might have. So please feel free to take advantage of that. So with that, our handy dandy disclosure slide, just to remind everybody, results are not guaranteed. And then a quick agenda. And then we'll go on to a look back on what's happened in the markets over the last year. So this is a helpful look at returns by asset class. And so a couple of things to note. One is that every one of those bars is positive. That's a good thing. That means most people's portfolios saw really nice gains over the last year. What's pretty remarkable is that 2024, we had positive returns in all those bars. And 2023, we also had positive returns in just about every one of those bars. So really back-to-back, very, very positive returns for stocks in particular. So you'll see all the way on the left, US stocks up 25%. I mean, that is an extraordinarily good number. And then remember that 2023, we had better than 20% returns there. So back-to-back, very, very stellar returns. Now, you'll see emerging markets there at about 8%, developed ex-US, so that's, Europe, Japan. Those also quite positive returns, but feel pretty small when comparing to that 25% return in the US. A lot of that was really driven by a strong dollar. When you look at fixed income, that's where, returns were not as strong in 2023, also fairly meager in 2024. The US aggregate is a broad sort of representation of different areas of the fixed income market. And you can see there only 1.3%. When you look at fixed income returns on a 3-year period, it's among the worst 3-year returns that we've ever seen. So even though 2024, we saw mildly positive numbers, that's coming on the heels of very negative performance the 2 previous years. So still, and we'll talk about some things that are really challenging the fixed income markets, but that's still been a much more challenging investing environment. You'll note that high yield there was really the exception in the fixed income world, up 8%. High yield is that those are like risky companies that, take more leverage or maybe less mature, less diversified than some of their peers. Because of that, they tend to act more like stocks. So it's not unusual that US high yield will have a really good year, that riskier stocks are doing well. So it's sort of inconsistent with how the market's been performing. And then you'll note commodities and real estate's also positive, despite some headwinds in both of those areas. When we look a little bit closer in the US equity market, break it down by sector, again, every sector across the board had positive returns. We'll let in materials at 0 over the year. What is consistent with what we saw in 2023 is that information technology and communication services really led the way. So not only were US stocks overall really, really strong in 2023 and 24, but the leaders in the market those 2 years were largely consistent from one year to the next. Again, that's unusual. Now, I will note that financials and utilities in particular were sort of new entrants into the top roster. Utilities had really lagged in 2023. Utilities have high dividend yields. And they often are seen as an alternative to fixed income. So for instance, many years when bond yields were very, very low, investors rotated into utilities in order to find that yield. Now that fixed income yields went up, a lot of investors kind of left utilities in 2023. Well, in 2024, as short-term interest rates started to come down, investors again rotated back into utilities for some yield. So in the second half of the year, you saw some pretty good performance there. Financials have been interesting, also an area that's very interest rate sensitive. So think like these are areas that have a lot of banks, for instance, that do a lot of lending and borrowing. And so they're very reliant on what yields are like at different points in the curve. And we'll talk about this, but as the yield curve normalized, which means short-term rates came down, long-term rates went up, that's a much more favorable operating environment for financial companies. So after a number of years of really lagging, financial companies started to see a little daylight in 2024. With that, let's take a peek at growth versus value. So in addition to looking at sectors, often we break down stocks into growth stocks and value stocks. Growth stocks are those that are, well, growing fast. So they typically have strong sales growth, strong earnings growth, and that growth is expected to continue to be quite strong going forward. On the value side, those are stocks that are representing value. What that means is that the valuations or how much we're paying for those stocks relative to how much those companies earn is relatively low. So for a growth stock that, think let me think, like Meta and Apple, these are sort of classic growth stocks. Google, these are companies that are very, very innovative. They have new products coming out. They're seen as really fast growers. And so investors are willing to pay a lot because that growth is going to continue. A value stock is one that might be growing more slowly and sort of overlooked by the market. And often what we see is that these two kinds of stocks go in cycles. So over the last couple of years, so this is looking back at the market over 2 years, what we see is that very dark line up top are Russell 3000, so very, very wide collection of stocks, large, small, mid, everything in between, but ones that are growth oriented, so the ones that are growing faster. You can see that over 2 years, that collection of stocks rose almost 90%. So really extraordinary performance. Value over that time period. So these are the beaten up stocks or the slower growers, but cheap. Those rose 27%. So you're talking about in a 2-year period, 60 percentage points difference between those two types of stocks. Now, again, often you'll have one performing well and the other one lagging, but the differential between those two is really quite extreme and much larger than what we typically see. This also comes on the heels of a prior 10-ish years where growth really outperformed as well. So you're getting to a point where you're sort of like stretching these two areas of the market where they're having very different experiences. There are other periods in time when value has outperformed strongly relative to growth. One recent time would be in 2000 after the tech bubble, right? Where those, more cheap companies that grew slower, had more mature businesses, are ones that outperform for a number of years. So just because this is what happened in the past doesn't mean that that's going to be what happens in the future. These things can change. All right, with that, let's take a quick look at treasury yields, because this has been another like really interesting change that's happened in the markets. And this is a big reason why those fixed income numbers that we looked at before didn't look so great. So you'll see that gold line is where the treasury yield curve was at the end of 2023. Let me just spend a moment on what a treasury yield curve is, because it's not obvious. So as you think about treasury bonds that go from 1-month maturity all the way out to 30-year maturity, typically what you'll find is a very short-term bond will have a lower yield than a long-term bond. So think about that. I got 3 kids, and I imagine one of them comes to me and says, "Mom, I want to borrow some money for a day." I'm like, "Okay." that doesn't seem very risky. I know that you're, getting a paycheck from your job that you have tomorrow. I know you're good for it. If a kid comes to me and they say, Mom, I want to borrow some money for 10 years, I'm going to be like, really? Like, what's going to happen in 10 years that I can count on the fact that you're going to come back and pay this back? I'm going to want more assurances from my kid that they're actually going to pay me back in 10 years. What that means is that it's riskier. I'm going to ask more for it. And I do that by having a higher yield on that bond or on that loan. So typically short-term rates are over here, long-term rates are over here, and it'll move around. However, over the last couple of years, things went in the opposite direction, where short-term rates were actually much higher than long-term rates. This is unusual. This is called an inverted yield curve, and it typically is very temporary. In our case, it lasted for 2 years, 2022 and 2023. In 2024, what we started to see is this normalization of the yield curve. So that's the dark line there. And you can see, if you look at that 5.39 on the gold line, went down to 4.28. That's a really large drop, right? It's almost a full percentage point over the course of 2024. So what drives that? That is the Federal Reserve. The Federal Reserve controls short-term interest rates. When they cut a quarter point, those short-term interest rates will fall very quickly. But when we look at the 30-year, this is interesting. It went from 3.88 to 4.78. So it actually went up during that time period. And this is a little unusual, but not wholly unusual. And I remember in September when the Federal Reserve cut for the first time last year, I happened to be traveling, and when I'm in a hotel room, I always turn on the local news because I'm kind of curious what's happening. And when I was there, they had a number of financial experts get on and talk about, oh yes, yesterday the Federal Reserve cut interest rates. People get ready because you can refinance your mortgage. And I was like, kind of cringing as I was listening to it because I was like, careful, that doesn't always happen. And sure enough, what we've seen is that since that September, when the Federal Reserve cut short-term interest rates, long-term interest rates have gone up. And in fact, mortgage rates are up about a full percentage point since the Fed cut interest rates. That's because the Fed does not control long-term interest rates. Long-term interest rates move up and down generally based on economic growth and future inflation expectations. So what the market is telling us is that they're expecting either stronger economic growth in the future or higher inflation in the future. And or some combination of those two. So again, sort of a complicated idea, but there's a lot wrapped up in here that then shows up in how your bond portfolios are performing. So with that, let's take a quick look at the economy. And we put together this economic dashboard as just sort of a synthesis of the main areas of the economy that we look at and kind of how things are doing. You'll see up top is monetary policy. So that's the Fed. That's them cutting interest rates, raising interest rates, buying bonds, selling bonds. And I grew up in this business with this mantra of don't fight the Fed. So there's a reason why the monetary policy and the Fed are at the top of this list. They are a huge impact on whether and how much the economy is growing. And because there's such a huge impact on the economy, they're also a huge impact on the market. Now, they're not always completely correlated, but they're heavily dependent on each other. And what you'll see there is that is in the green. That is the Fed cutting interest rates. Now, the Fed is cutting interest rates at a slower pace than what the market had hoped, but they are indeed coming down. I'll highlight one other thing on here, which is at the other end of the spectrum, which is housing. You'll see that moving in on the red. And this is one area that is very, very different depending on what region you're in. I'm here in Austin, Texas, where houses are sitting for much longer than they had been. Prices are down from their peak. Activity has really, really slowed. There are other areas of the country that are experiencing different levels of activity. But in general, when we put all these things together, housing activity has been much lower than what we have typically seen over the last couple of years. So with that, let's dig into some of these categories a little bit more. We just did a piece a couple of days ago on inflation. And so I think this is one that is very much on people's minds. We've been talking about this for a while in that the Fed has targeted a 2% inflation rate, right? So you can even see back there, it was back in 2012, I think, 2011, 12, that the Fed came out and said, we think 2% inflation is the right amount. And that's what we're going to manage our monetary policy to. So if inflation gets above that, they're going to raise interest rates and try and slow inflation. If inflation gets too far below, they're going to cut interest rates and try and stimulate the economy and have inflation up. So you'll see, though, if you look back on average from about 1990 to today, the average inflation rate has actually been 2.5%. So that 2% target is actually a pretty low rate, even based on the last couple of decades of experience. And then, in fact, if you go back even further to pre-1990, you'll see 4.8%. Now, there's a good reason why the Fed might ignore that, right? Those were back-to-back recessions, oil shock, runaway inflation. So, okay, even if you accept that we're not going to use that experience to inform what we think now, 2.5% seems like a pretty aggressive bogey. And you'll note there that recently we've been running in like the low threes. And you'll see too, it's a little hard to see, but if you really look closely, you'll see that the last few readings have really plateaued. And we're sort of like stuck at this low 3% inflation rate. We think that it's going to be hard to get below that. And at some point, the Fed will probably have to back off that 2% inflation rate. But they're also going to be worried that we could see an uptick in inflation going forward. And so that's really why they have to be very, very cautious and not cut interest rates too much. So with that, there's been some toing and froing about what happens with the Fed funds rate. All right. So remember that Treasury yield curve, right? Where the low interest rate, shorter term interest rates are low, longer term interest rates are high. The Fed funds rate is the overnight rate. So it's the shortest kind of rate that you can get. And that is what the Fed controls. They move that up and down. So that helps determine all of those other kind of short-term rates. In December of 2024, so a little over a year ago, just a few weeks ago, December 2024, the Fed funds rate ended the year at 4.3%. At that time, or as of a couple of days ago, markets expected the Fed funds rate to get to 4.1%. What you'll note is that that's not a big decline. If you looked back a number of years ago, the market was expecting a lot more cuts than that. This is like one, maybe two cuts. And it's even at certain times over the last couple of weeks, the market has said, well, we don't think that the Fed's going to cut at all. And what that is, it's because we've had a number of pieces of inflation data that are in that 3% range, right? And that's higher than what the Fed is comfortable with. So the market has had to back off and reduce its expectations for how much the Fed can really cut. And so if you remember back to our economic dashboard, we have the Fed almost in the green, but not quite. And this is really what's preventing that from going all the way in the green. And as I said earlier, this then has sometimes an unexpected impact on long-term interest rates. So we have a chart of 10-year Treasury yield. And what you'll see here is, I was talking about this day in September. I was watching on the news as people talked about lower long-term interest rates. The Fed cut in September. And then over the course of the next couple of months, Treasury yields just went up and up and up. And with that, we also saw mortgage rates go up and up. So unfortunately, for anybody who's looking for an opportunity to refi their mortgage or buy a new home, this is a big headwind. Okay, with that, let's talk about manufacturing and services activity. So this is a survey that folks will use to talk to different companies and get very quick on-the-ground view about how business is going. The blue line looks at manufacturing companies, and this is the manufacturing series goes back to the 1970s. So we have some really rich history here. If you notice, that blue line has been below the 50 level for over 2 years. Anything below 50 suggests that manufacturing activity is contracting. You will note that that 2 years is pretty much the longest that we've ever seen this in contractionary territory. And I would argue that if you remember, a couple of years ago, everybody was talking about recession, and then it never happened. I would argue that it did happen. It just happened in only parts of the economy, namely manufacturing. And when I talk with business owners in the manufacturing space, that line feels more like their experience. They're like, yeah, it's been really rough out there. We really haven't seen business pick up since pre-COVID. Um, the gold line is why the overall economy has continued to chug along. That's services. So these are hairdressers, accountants, consultants, anything where you don't have like a product, so like a tangible product associated with it. You'll see there, we kind of flirted with 50 or neutral, but it quickly bounced back. And over the course of 2024, actually had quite good performance. And so that has really been the big driver of economic activity overall. Now, when we look at consumer spending, specifically retail spending, this is another area that has really shown some strength. So this is looking at real retail sales growth. So we look at the overall amount of dollars that consumers are spending, and then we take out inflation, which, as you guys probably know, has been a really big impact on overall dollars. You'll see that huge spike during COVID. That was all of the stimulus payments that individuals got, many of which got redeployed into purchases. But then you'll see in 2023 that big drawdown. So after taking inflation out of the equation, during that period, consumers were actually buying less. Now, they may have been spending more dollars. So think about it. As you go to the grocery store over the last couple of years, the price of eggs has gone up substantially. The price of meat has gone up substantially. The price of milk has gone up substantially. So as you go shopping, your bill for that same basket of goods has gone up substantially over the last couple of years. But you might be buying less milk, or you might be buying fewer eggs. So what you're getting for those dollars actually went down in 2023. The good news is that as inflation slowed, consumers were able to continue to be able to grow a bit the goods and services that they were buying with the same amount of dollars. So what you see there is real retail sales started to pick up, and we take autos out of this because it makes the number very volatile. Now we're still at about neutral. So after adjusting for inflation, people are spending about the same as they had been earlier in the year. But this shows some underlying strength among the consumers. And in fact, as we look at holiday sales, which is a really important part of overall retail sales, you can see there went up almost 4% year over year. So that's a pretty strong number and suggests that underlying health of the consumer is pretty good. On the other hand, if you ask consumers how they're feeling, they're going to say not so great. And this is a very sort of puzzling thing for economists to really understand. But so this is, and we have a number of different measures of this. This is the one from University of Michigan. And what you'll see there, that red line shows you the average level of consumer sentiment during recessions. So if we track how consumers are saying they feel about the economy, over the last couple of years, sentiment has been lower than what you've typically seen during recessionary periods, even though the economy kept growing. So it's kind of remarkable. There's this big disconnect. And I think the big reason is because of inflation. So even though wages were increasing, when people went to the grocery store, they weren't buying as many eggs because their dollars didn't go as far. And that made people very pessimistic about the economy. As inflation has started to subside, you've seen that number beginning to improve. It's still not back to where we have seen during other like sort of strong economic cycles, but it is improving because of that. But when we look at what consumers are actually doing, that's the retail spending on the previous chart, they're still going out and spending dollars. So they're acting like they feel better than they say they feel. It's always a bit of a puzzle. So with that, a lot of what underpins all of this is the labor market, because it's very difficult for people to say that they feel good about the economy or to be able to spend if they don't feel like their jobs are secure. And there, we've definitely seen some softening in the labor market. So this particular indicator goes to small business owners and asks them, are you expected to hire more? How many jobs do you currently have open? There are a whole bunch of different questions that these owners get asked. This you can see has come down quite significantly since 2022. But the level of job openings among small businesses today, you'll see is about at the level it was pre-COVID, which, by the way, was an extraordinarily strong labor market. And so I think we sort of forget sometimes that the labor market that we have today, even though it's a little bit tighter and not as many job openings, when we compare it to history going back to 1960, we have among the best labor markets that we've ever had, and with really, really abundant jobs. Now, going forward, I would expect it to continue tighten a little bit further. But in general, that's a pretty strong underpinning for consumers. All right, so with that, let's look at stocks and bonds. So I mentioned that 2023 was a really strong year for large cap stocks. 2024, I mean, it just felt like one high after another. I kind of got tired of watching CNBC and seeing them count like how many new highs we had in the S&P or the NASDAQ over the course of 2024. But it can be easy to forget that all of those new highs happened at a time when there were a lot of really negative headlines. I mean, think about it. Russia-Ukraine war in its second year, the continued conflicts in Gaza and the Middle East. You had Biden exiting. You had 2 assassination attempts on Trump. You had the unwinding of the yen carry trade. And then, oh yeah, election day, which tends to be a really volatile period in markets. And then conflict in Syria. So, I mean, if you had handed somebody this list of headlines, you never guess that the S&P would be up 25%. And one of the other mantras I grew up in the market with is markets climb a wall of worry. So those headlines are the worry, right? And then that market is just climbing higher despite all of those negative headlines. So it was really quite remarkable. And I mentioned earlier that much of that strength in the S&P 500 was dominated by what we call the Magnificent Seven. So at this point, you know, you've probably heard, if you ever have CNBC on in your house, you've heard about the Mag 7. And it's always kind of fun to test people and see if you can name all 7. But I'm going to give you guys the answer. If you look at those notes on the bottom, you'll see all the different names that are in the Mag 7. So, you know, they're all familiar: Tesla, Google, Meta, NVIDIA, Microsoft, Amazon, Apple. And look at that really incredible performance. So when you index it for the year of 2024, in aggregate, those 7 names are up over 150%. And again, this is after 2023. That was really, really strong. The gold line is the S&P 500. Looks really paltry, right? Doesn't look so exciting. But that 25% return is really incredible. And then, of course, the poor Russell 2000, which are small cap stocks, I think those were up like 8-9%, which is normally a really good year. But when you compare it to 160%, it doesn't really feel like it. So it's also easy to forget that small cap stocks, if we look like way back in history, small cap stocks actually tend to do better over time than large cap stocks. It sure hasn't felt that way over the last 2 years. But one way of measuring that is looking at the S&P 500 as we normally talk about it, where it's market cap weighted. That means the largest companies in the S&P 500 have a larger weight. So what happens with them, and in this case, those are largely the Mag 7, what happens with them has a huge influence on what happens on the overall market. But then we compare that to the equal weighted S&P 500. That's where we take all 500 or so names in the index and we say everybody has an equal say, and we average those out. So if you look from 1995 to current, those bars on the left, you'll see equal weighted actually does better than market cap weighted. And, you know, we're talking about 0.5 percentage point, which might not seem like a lot, but when you think about that over a 30-year period, that has a big impact over time. But then if we zero in on just the last 2 years, right? So starting beginning of 2023, going all the way to the end of 2024, you'll see a massive difference where market cap weighted stocks have nearly double the performance of equal weighted. So it's helpful to remember that the type of experience that we've had more recently is not typical. What that means is that at some point it's likely to change. Identifying exactly when that turning point is very, very difficult, but that's why you have to be ready for it when it comes. And so the question is, what is going to change it? One thing that could contribute to that shift is earnings power. So here we look at earnings of the Mag 7, right? Those 7 big names, and then everybody else. I need to come up with a better name for the, S&P 500 X Mag 7. We also call it the S&P 493, or but we need a clever name to compete with the Mag 7. So this is showing earnings by quarter for the Mag 7, that's the blue line or blue bar, versus earnings by quarter for everybody else in the S&P 500. So zero in on 2023 and 24. Those are the last 2 years when you remember Mag 7 increased in aggregate by, well, it was over 200%, by an enormous amount. Now look at the earnings, right? Those blue bars, look at how much those are growing, 30, 50, 60+%. Really incredible growth. So what that tells you is that there were strong earnings underpinnings for those names to do really well. This is partly driven by the AI revolution, right? New products, changing the way that people behave, huge numbers of applications for it in other industries, naturally really drove earnings. So there was a strong fundamental reason why NVIDIA and Meta and all these other guys have done really, really well. But now let's zero in on those kind of shaded bars towards the right. That's 2025. What you see is those blue bars starting to decelerate. Still very strong growth, right? By Q4 2025, the Mag 7 are expected to have about 21% growth in earnings. That's really great. But what we see is the gold bar starting to catch up. By the end of 2025, we're looking at about 18% growth. So what you start to see is a convergence of these two groups of stocks. So with that, that could help to sort of change the picture a little bit and give room for some of these smaller names to really shine through and to be recognized again by the market. So again, hard to identify exactly when that's going to happen, but this earnings picture will certainly be a boost for some of these other names. One other piece of this puzzle is valuations. So how much are we paying for these earnings? So if we look at, this is just, a 25-year chart looking at the price to forward earnings for the overall S&P 500. You'll see there we're running at about 22 times next year's earnings. That's pretty high, and that's among the highest that we've seen in 25 years. And that's well above the average of a little over 16. If we pull it apart, though, again, we do that same exercise where we have a PE for the Mag 7 and a PE for everybody else. The Mag 7 PE is well above everybody else. So it's hard to kind of deal with this in a broad brush. And those other names have lower valuations and are going to be seeing improving earnings going forward. So again, I think it sets up pretty nicely for seeing more stocks participating in this going forward. Let's just spend a moment on the fixed income side, and I want to make sure that we get to your questions. One thing that we're watching, I mentioned earlier that in 2024, high yield was an area that did the best, up about 8% last year. That's happening at a time when we see little things that we're keeping a closer eye on. Again, we don't think that these are huge red flags, but they are things that give us a bit of caution. So on the left are corporate bankruptcy filings. You'll see in 2024, that was the highest level that we've seen since 2010. Now, it's not shooting up, right? It's not massive. In fact, we're still below the 2010 levels, but it is increasing. And it's also increasing at a time when you'll see on the right, these are what we call the high yield option adjusted spreads. It's a fancy term for saying how expensive are high yield bonds. I mentioned earlier that high yield bonds are those that come from companies that tend to have higher debt levels, less mature businesses, more erratic earnings. The spread is how much you're paying or how much you're getting paid to own that type of bond versus, let's say, a treasury. And there, what you'll find is that it's been going down quite consistently. And spreads today are among their tightest than they've been going back to 2010. So what that tells us is that the market doesn't have a lot of risk that's priced into these. So with little risk priced in and some rising risk on the other side, it just makes us a little bit more cautious on the high yield side. All right, couple of things I'm going to mention about the election impact, and then we can go to questions. We've been talking for much of 2024 about how the individual in the White House actually has very limited impact on markets over the medium to long term. That said, right around elections, you can see some volatility as markets try to adjust to whoever they think is going to be put in the office. But in our experience, these things tend to be quite fleeting. So one example is on the left, you'll see semiconductors versus software. One big topic during this election has been on tariffs. And the market has done a lot of jockeying to try and figure out how to think about and how to price in potential tariffs. So semiconductors, which is that dark line, are largely built outside of the US. So meaning they have to be imported, meaning that if there is some sort of blanket tariff, semiconductors all of a sudden become more expensive. The gold line is software, which is usually built here in the US, therefore immune to tariffs. You'll see on election day, semiconductors start to come down and software start to come up. Now that went on for a couple of weeks, but then you'll note later in the year, they started to diverge again. And that impact seemed to not be as big. On the right, you'll see a similar phenomenon where the red line is a Republican basket. So these are stocks expected to benefit from a Republican in the White House. Blue line is a similarly constructed basket of companies expected to benefit from a Democrat in the White House. And what you see is that those jockeyed for position throughout the year as polls showed one candidate leading versus another. Then on election day, big divergence, right, as Republican stocks outperformed. But then as the year went on, they started to converge again. And when we've looked at this over prior presidential cycles, what we found is that the presidential effect wanes pretty quickly. I will note, though, that in the gold there, you'll see Bitcoin, which is a whole other topic in itself. But what you do see there is a very clear sort of pricing in of a more favorable regulatory environment for crypto that seems to have persisted more than some of these other things. Quick mention on tax cuts, which is another area where I tend to get a lot of questions. I happened to have been on Capitol Hill just like a month or two before the election and talking with legislators. At that time, it was very much up in the air who was going to win the election. But there was a broad assumption that if Trump won, that the tax cuts that he put into effect during his administration were simply going to be extended. So we'll see. Legislators are already kind of tinkering with what that looks like. But assuming that those tax cuts simply get extended, you can see that gold bar about how much impact there is on the federal deficit. Now, there's talk about trying to also cut federal spending as we also put in these federal tax cuts. That's extraordinarily difficult to do. So right now, bias is up in general for how big the deficit will grow. One more point on tariffs, and this is where it's a little hard to like keep up because there's a lot happening. These are the tariffs that Trump had proposed on the campaign trail. What we've already seen in the first 3 days of his office is that these aren't necessarily set in stone, and you should expect changes along the way. What I will say is that there's a lot of hand-wringing over tariffs, largely because of its inflationary impact. So for instance, if we have a 10% baseline tariff on all imports, let's assume half of it gets passed through to individual consumers, that's higher prices, right? And that's inflationary. But what I will say is that if there is a policy mistake, let's say 60% tariff gets put on all imports and people are up in arms and the market crashes, those tariffs can be taken off. So as easy as tariffs are to put on, they can also be taken off. But there might be a little bit of a learning curve as policymakers sort of experiment with how much they can get away with and where they feel like they're going to get benefit on tariffs. So hard to say for sure exactly what direction we're going to go, but expect it to be changeable as we go forward. Last slide I'll leave you with, which is among my favorites. This is from our friend Professor Jeremy Siegel, who was the one who originally put this data together, looking at asset prices over the last 200 plus years. And the reason why I love this, again, like we get so lost in the weeds sometimes and like figuring out what's going to happen tomorrow that it can be easy to lose the big picture. This is the big picture. And in my mind, it's really about that quote at the bottom. Stocks are the most volatile asset class in the short run. So that means when we're looking at it by day, by month, even a year, stocks move up and down a lot. But when we back up, they're actually the most stable in the long run. And if you look at that trend line, that's that red line that goes up and to the right, it is remarkably consistent over a 220-year period, that over time stocks tend to grow, and the number is about 6.6% after inflation. And when Professor Siegel first put this data together back in the 1980s, the average long-term inflation-adjusted return for stocks was 6.6%. Well, guess what? 40 years later, he's still doing these numbers, and the average long-term return is 6.6%, right? So it just gives you an idea about how consistent over time that is. So stocks are just a great, great way to build wealth over time. And you'll see bonds have a nice second place, right? They're a great sort of addition, diversifier to your portfolio, and they can also help smooth out that ride over time. So with that, thank you so much for listening to all of this. Let me pull up some questions and see what we've got here. So any thoughts on how tariffs may impact manufacturing sentiment or inflation? Yeah, so I've seen a number of studies coming out so far trying to identify how much of tariffs are going to be passed on to consumers. And so far, it's really anybody's guess. What we saw during the first round of tariffs during Trump 1.0, is that there seemed to be, and again, this is where economists can argue with each other, there seemed to be a mild inflationary impact from those tariffs. What we also found is that because the tariffs were targeted towards China, US companies and individuals shifted their purchasing from China to Europe. So what that meant is that the amount of trade with China went down, the amount of trade with Europe went up. If we have anything like a blanket tariff, you can't do that, right? You can shift from things that are bought outside to things that are bought inside. That is, in many ways, a political goal, right? So I think Trump, one of the goals of tariffs is actually to stimulate US-based manufacturing production. And if you make goods that are imported from elsewhere in the world really expensive, you sort of create an advantage for US-based manufacturers. The challenge is that takes a long time, right? Think about how long it takes to build a factory. That could easily be years for those to come online again. So to your question about manufacturing sentiment, to a certain extent, some US homegrown manufacturers might be really excited, right? All of a sudden, they've just eliminated their non-US competition. However, a lot of those US manufacturers might import a lot of goods from outside. And so suddenly it becomes more costly to produce what they want to produce. So all of that's to say, it's really, really complicated. And it's going to depend very much on who you're competing with and how much you're buying from abroad. So in general, I'd say, I think probably a little bit negative for manufacturing sentiment and a little bit stimulative in terms of inflation, but very much remains to be seen. Another question, was the last table after inflation or includes inflation? So Ryan, do you mind bringing up the stocks for the long run chart? We'll take another look at it. So the answer is that all these numbers are after inflation. And you can imagine that it's not an easy task to go back to like 1820 and figure out what the inflation rate was and be able to adjust all these numbers. But yeah, stocks over that 220-year period have a compound annual rate of growth after inflation of 6.6%. And if you're interested, we have this version of it of the chart with a table in it that gives you the actual numbers by asset class. So feel free to reach out to your financial advisor and we can get that for you. All right, any other questions? Great. Well, I will let you folks go. Know that these are available. You know, I mentioned the stocks for the long run that are available for you. Just reach out to your advisor. But any of these slides are available if you're curious to dig in some more. And thank you so much for joining us, and invest wisely and live richly. Take care.